Every day, new investors dive into the market, fueled by excitement and ambition. But without the right knowledge, that ambition can lead to costly errors. Imagine someone eager to grow their wealth, only to be caught off guard by avoidable pitfalls. It's a harsh reality, but it doesn't have to be yours. Think about it. What if you could sidestep these traps? What if you could learn from the missteps of others rather than making them yourself? As we unravel the common mistakes that can derail your investment journey, keep your mind open. Each mistake is a lesson, and every lesson is a step closer to success. Are you ready to secure your financial future? But first, subscribe to the channel. Here, you'll learn how to boost your income and invest smartly. Turn on notifications so you don't miss any tips. Let's go! Lack of planning and financial goals. When it comes to investing, many people jump in without a clear plan, and this can lead to all sorts of problems. Setting specific, realistic goals is crucial. Think about what you want to achieve with your investments. Do you want to save for a house, a vacation, or retirement? Each goal has its own timeline and financial target, and understanding these can help you make smarter investment choices. Moreover, having a timeline for your goals can guide your investment strategy. For instance, if you're planning to buy a house in 5 years, you'll likely want to choose less risky investments compared to someone who is investing for retirement 30 years down the road. By outlining your goals, you can measure your progress and make adjustments along the way, giving you a clearer path toward achieving what you desire. It's also important to be realistic about your targets. Setting goals that are too ambitious can lead to disappointment and potentially dangerous investment decisions. The key is to find a balance between aspiration and reality. This means considering factors like your current financial situation, market conditions, and the time you can commit to managing your investments. In addition, revisiting and revising your goals regularly is a good practice. Life changes, and so do financial situations. By staying flexible, you can ensure that your investment strategy aligns with your evolving goals. This ongoing evaluation helps you stay focused and motivated, keeping your investments on track. Finally, remember that a well-defined plan doesn't just help you stay organized, it also builds your confidence as an investor. Knowing you have a strategy in place can reduce anxiety and help you make decisions that are in line with your financial aspirations. Ignoring investment diversification. One common mistake among investors is putting all their eggs in one basket. Concentrating your investments in a single asset or sector may seem like a good idea when things are going well, but it can be risky. If that particular investment takes a downturn, your entire financial future could be at stake. Diversification is a strategy that helps mitigate this risk. By spreading your investments across various assets, like stocks, bonds, and real estate, you can protect yourself against market volatility. For example, if the stock market experiences a decline, bonds or real estate might perform better, balancing out your overall portfolio. This approach can provide a more stable return on your investments over time. Furthermore, diversification doesn't mean just investing in different assets, but also different industries and regions. A well-rounded portfolio could include technology stocks, agricultural investments, and even international markets. This way, you're less vulnerable to the ups and downs of a single sector. It's also essential to regularly review your portfolio to ensure it remains diversified. Markets change, and so do economic conditions. You may need to adjust your investments periodically to maintain a balanced approach. This might involve selling off certain assets or investing in new areas that show promise. In conclusion, ignoring the importance of diversification can lead to significant losses. A diversified portfolio not only enhances your chances of achieving a stable return, but also provides peace of mind, knowing that you're prepared for whatever the market throws your way. Making emotional decisions. Investing is as much about psychology as it is about finance. Many investors let their emotions dictate their decisions, especially fear and greed. When the market drops, fear can cause panic selling, leading to losses that could have been avoided. On the other hand, when the market is on a high, the desire to capitalize can lead to risky investments without proper research. To combat these emotional pitfalls, maintaining discipline is key. Setting predetermined rules for buying and selling can help keep your emotions in check. For instance, you might decide to sell a stock only if it drops below a certain price, or to buy more shares when prices fall. These rules can provide a structured approach, allowing you to make decisions based on logic rather than emotion. Moreover, it's crucial to take a step back and evaluate your investment strategy regularly. Reflecting on your decisions can help you identify patterns in your emotional responses. If you notice that you tend to sell in a panic or chase after hot stocks, you can work on strategies to counter these tendencies. Another useful technique is to talk to someone else about your investment decisions. Whether it's a financial advisor or a trusted friend, sharing your thoughts can provide new perspectives and lessen the emotional burden. This can lead to more rational decision-making, ensuring that your investments are guided by sound principles rather than fleeting feelings. Ultimately, recognizing and managing your emotions can make a significant difference in your investment journey. By adopting a disciplined approach and focusing on long-term goals, you can avoid the common traps that many investors fall into when swayed by their feelings. Not investing in knowledge. Investing without understanding can lead to significant losses. Many people jump into investments without taking the time to learn about various options and strategies. It's essential to educate oneself about different types of investments, such as stocks, bonds, mutual funds, and real estate. Each investment vehicle has its own risks and rewards, and knowing the basics can help investors make informed choices. Moreover, understanding market trends and economic indicators can provide valuable insights. For instance, knowing how interest rates affect bond prices or how inflation impacts purchasing power can influence an investor's strategy. Without this knowledge, individuals may react impulsively to market changes, leading to poor investment decisions. Investors should also familiarize themselves with the companies or funds they are considering. Researching a company's financial health, management team, and industry position can reveal whether an investment is sound. Many investors overlook this critical step, which can result in unexpected losses when the market shifts. There are numerous resources available for those looking to educate themselves. Online courses, books, podcasts, and webinars can provide a wealth of information. Joining investment clubs or forums can also be beneficial, as these platforms allow individuals to share experiences and learn from one another. Ultimately, investing in knowledge is just as important as investing money. The more informed an investor is, the better equipped they will be to navigate the complexities of the financial markets. By making education a priority, investors can enhance their chances of achieving their financial goals. Disregarding costs and fees. One of the most overlooked aspects of investing is the impact of costs and fees on overall returns. Many investors focus solely on the potential gains without considering the fees associated with their investments. These costs can include brokerage fees, management fees, and taxes, all of which can eat into profits over time. For example, if an investor earns a 10% return on an investment but pays 2% in fees, their actual return is only 8%. This difference, though it may seem small, can compound significantly over many years. Therefore, understanding the fee structure of any investment is crucial to maximizing returns. Investors should also be aware of hidden fees that may not be immediately apparent. Some mutual funds have high expense ratios or can charge sales loads that eat into the initial investment. Reading the fine print and asking questions can help uncover these costs before making a commitment. Choosing low-cost investment options such as index funds or exchange-traded funds called ETFs can also help minimize expenses. These types of funds typically have lower fees compared to actively managed funds, allowing investors to keep more of their earnings. By being mindful of costs and fees, investors can significantly improve their overall investment performance. It's a simple yet often neglected strategy that can pay off in the long run, helping investors keep more of what they earn and reach their financial goals faster. When it comes to investing, many people tend to overlook the costs and fees associated with their choices. This oversight can have a significant impact on the overall returns of their investments. For instance, fees like broker commissions and management fees may seem small at first glance, but over time they can add up and eat into your profits. It's essential to be aware of these expenses so you can make informed decisions that support your financial goals. Investors often focus on the potential returns of an investment without considering how much they will have to pay to achieve those returns. For example, a mutual fund may advertise impressive returns, but if it has high management fees, those returns might not be as attractive once the fees are deducted. This is why it's crucial to read the fine print and understand the fee structure of any investment vehicle you're considering. Ignoring these details can lead to unpleasant surprises down the road. Additionally, taxes can also take a bite out of your investment returns. Many investors fail to account for capital gains taxes when they sell their assets. This can lead to a drastic reduction in the amount of money they actually pocket after the sale. Understanding the tax implications of your investments is just as important as knowing the expected returns. It's wise to consult a tax advisor or do thorough research to ensure you're not caught off guard when it's time to file your taxes. Choosing more economical options can help mitigate these costs. There are a variety of low-cost investment options available today, including index funds and ETFs that charge lower fees than traditional mutual funds. These options can provide a more cost-effective way to build a diversified portfolio. The more you save on fees, the more you can potentially earn in the long run, as your investment can grow without the burden of high costs dragging it down. Lastly, being proactive about understanding and managing costs is a critical part of a successful investment strategy. Regularly reviewing your investment accounts and their associated fees can help you identify areas where you might save money. If you notice that certain investments are costing you too much, it may be time to reassess your choices. By keeping a close eye on costs and making informed decisions, you can enhance your overall investment experience and work towards achieving your financial objectives more effectively. As we wrap up our journey through the 5 critical mistakes new investors must avoid, it's essential to remember that every choice you make shapes your financial future. Are you eager to break free from the cycle of losing money? Ask yourself, what strategy will you implement today to safeguard your investments? Remember, knowledge is your greatest ally. Don't just take notes, take action. Have you considered setting a budget for your investments? Or perhaps diversifying your portfolio to spread risk? Every decision counts. And don't forget the importance of continuous learning. What resources will you tap into next? Podcasts, books, or maybe even online courses? The world of finance is ever evolving, and staying informed is key to your success. So, as you step into this exciting world of investing, keep these lessons in mind. Challenge yourself to avoid these pitfalls and watch your wealth grow. What's your next step? Share your thoughts in the comments below. Your journey could inspire others. Stay curious, stay proactive, and remember, your financial future is in your hands. Let's keep moving forward together, and until next time, keep investing wisely.